Hello everybody and welcome to Carlin Cymru revision sessions. This session this evening will focus on GCSE Business Studies Finance and cover everything from source of finance, cash flow forecast, break-even analysis and profit and loss account, and hopefully give you a bit of an idea, a bit of a revision session surrounding that subject. The session will last around 45 minutes and my name is Paul Woodhouse and I will run through the relevant content. If you've got any questions during the session, then please publish it in the Q&A section and we'll do our best to answer the questions as we go along. If you're happy to leave your name and email address, we would love to keep in touch with you so that we can send you some information about further events. You can click on the link at any time during the session. Today's session will be recorded and the recording and any relevant resources will be uploaded to the e-sgol website under Carlin Cymru tab. Thank you very much. And we shall begin. So, as I said, we're going to look at the world of finance today and revise sort of that topic. Very sort of different to last week. For those of you that watched the video or the pre-recording from last week, last week was more about the TED acronym and trying to work out your sort of paragraphs in those longer extended mark answers and working through that section. Within the finance section, typically the questions come in sort of 1, 2, 4, 6 mark answers. They can throw in the occasional 8 and 10, and I will refer to those at the end. So to begin with, if anybody is available and would like to, you can write down a source of finance that is available to a startup business in Wales. And that's something where I'd like to begin really, is that when you get your exam, the questions are going to be relevant to businesses in Wales, and you will probably get 2 mark questions for the majority. One where you will have an AO1 knowledge mark and another where it might be AO2. So therefore you are having that source of finance, but it needs to be relevant to the case study. So if it's a business startup, you're not thinking like share capital, for instance, because that would obviously refer a larger company, private or public limited company, depending on what you are talking about. So please make sure that is relevant to your sort of area. So is what I sort of envisaged for this evening is to revise the key concepts of finance, apply these concepts to different exam questions, and then demonstrate some of those understanding through some of the skills that we're going to refer to. So what is the function of the finance department? Yeah, so first of all, we're managing the money that flows in and out of the business. That's primarily what the finance department is doing. And it's a very important role, obviously, within the business to make sure that the finances are kept up to date and you're not going over budget, you're not overspending. So looking for some sources of finance for a startup business, growth, or paying and the day-to-day expenses of the business. So again, sometimes we all should be aware by now that within the first 2 years, you may struggle to survive. So it may be that you're looking for sources of finance just to pay those day-to-day running parts of the business. Or you could be 3 or 4 years down the line, you're looking to expand your business, move into a larger store, extension, build more products or introducing more products into the range. And therefore you need more capital in order to do that. And it's about how we go about getting that information. So if you're working in that business or in that financial department, and I always like to make it relevant to a financial area. So if you are, or a financial job, so if you are in that role, you will be expecting to look at, analyze, adapt, create financial documents. So in the WJC GCSE specification, it's very much about adapting those financial statements and then a little bit of analysis. For those of you thinking about the next step in terms of A-level, you go further into that analysis and evaluation. So we're going to look at some different documents there. Another purpose of that financial function is to maintain the financial records, and we need to analyse these to make sure that the business performance is going in the right direction. So you might see this little TED sign in the top left-hand corner occasionally. So again, it's just thinking about when you get those questions, you're talking about a point, you're making a statement, you're explaining it, and you're developing it. You're talking about the impact of that business on the business. So again, I'm going to refer to that here. So you might have some internal and external source of finance. And you need to understand the benefits and drawbacks of those. Now, I'm not going to go into too much detail about those this evening because it's an area that you can go away and revise individually. Put them onto flashcards, create your mind maps, retrieval information. So blank piece of paper in front of you, write down as many sources of finance as you can, internal and external. A little branch coming off them, an advantage, one disadvantage, a use for it. So you're starting to build up that knowledge of internal and external sources of finance. So within that, you also need to be aware, as I sort of said in the last slide, you need to be aware of small and large businesses within those. So what is the impact that this will have on the business? So now we're going on to that D stage of TED. So the development, the impact it has on the business. So your first point is on these 6, 8 or 10 mark questions, your first point is a relevant source of finance. So let's say, just for instance, it might be an overdraft. So then I want you to tell me about an advantage and disadvantage of using an overdraft. So an advantage might be it's a really quick short-term source of finance that's readily available to businesses. A disadvantage might be that there's large amounts of interest applied to an overdraft, or doesn't allow capacity for larger amounts of lending. So then that impact on the business, what impact is that having? This will allow the business to solve some short-term financial problems. So you're stating that impact it has on the business. So it could be that if you're looking at larger sums. So again, now we're going away from startup businesses, it might be looking at growth. So if you're using capital, share capital, a loan, it could be for growth purposes. And that impact would be then to allow the business to grow. And here are some of those sources of finance that I just referred to. So we can split them into internal and external. Apologies there, on the right hand side, it should be internal sources of finance. So we've got those internal sources which come from within the business, the owner's capital, the retained profit, the profit that has been kept by the business, or the profit that's been made by the business. Or it could be a selling of asset. You've got a taxi firm that has a fleet of 10 taxis. You realise that you've got some financial difficulty, or you're looking at raising some new finance for a new USP, electric vehicle. You might sell off 1 or 2 of your existing range in order to invest in something different. So you're selling assets to raise capital. And hopefully already you've started to hear me use the term capital instead of money. So in your questions or in your exam questions, I want you to try and avoid that term, the word money. So you're using capital referring to what's available. So some of those external sources of finance, and we've got much more of these to choose from. So again, know 2 or 3 of them in detail. You don't need to know every single one of them. Okay, but family and friends, it's a short term, it's quick, it's probably a small amount of capital that's available. So it could be that you've got a bank loan or an overdraft. Make sure you know the advantages and disadvantages of each. It could be that you've got a venture capitalist. So that is somebody like a Dragon's Den idea where they will invest in the business and they will either provide some advice or they will be a sort of silent partner. You could have a new partner come along. You could have issue shares. You could have trade credit. Remember, trade credit is where you buy something, but you don't pay for it up front. So therefore it is a form of credit. Okay, so you might purchase in a building firm 10,000 building bricks. Now you won't pay for those immediately, or you probably won't pay for those immediately, but you might be given 3 months to pay for those. So you're taking out trade credit. Again, similar sort of concept, leasing. So this will be more for a vehicle or piece of equipment. You're almost hiring that piece of equipment. You pay for it. You may pay it back at the end. You might pay it outright at the end, but you are borrowing it and you're paying a fee to do so. And then lots of government grants available, and especially know about your government grants for your startup businesses. Often comes up as an exam question is, for a startup business, what government grants are available, or who could I go for to advice? So make sure again you're aware of local authority businesses, Prince's Trust, things, people like that. So just a little bit of revision for you. Okay, so again, just putting it into some concepts so you don't not listen to me all the time. Okay, and you can pause your screen now if you wish to, and you can come back to join in the rest of the conversation or the rest of the explanation revision session in the meantime. So here are your 4 sort of key questions on source of finance. So explain the difference between a bank loan and an overdraft. What is it like? What type of business is likely to attract investment from a venture capitalist? How can a business owner attract new partners to provide finance? And discuss advantages and disadvantages of government grants as a source of finance for a business. So just put those as 2 and 4 mark answers. Like I said, if you'd like to pause it now, okay, and I will continue just so we're not waiting around. So the next element of finance, moving away from the sources of finance that are available and getting into a bit of the nitty gritty, some of the formulas, some of the calculations. And some of you that are listening to this presentation might find this area particularly challenging. Now, it might be that in maths you're disengaged, it may be that you don't particularly like a teacher, or you just find it very difficult to use number. Now in business, you've obviously got a calculator, so you've got everything available to you. So although yes, a good understanding of numeracy is beneficial, it's not essential. So please make sure that you're not put off by some of these questions, because they are accessible to every single one of you. So calculate the revenue from for the following business. So assuming that McDonald's sell 250,000 Happy Meals each day in the UK. If each Happy Meal costs £2.69, calculate the daily revenue for Happy Meals. So is all we're doing, okay, is looking at 250,000 times by our selling price. So 250,000 times by £2.69 should give us £672,500. So he's all we've done there, just so you've got the formula for it. For you remember, for your revenue, just bring it up here. So for your revenue, it is selling price times by number of items sold. So simple formula for revenue, your selling price times by the number of items sold. If you forget that in your exam, then look at the case study, because it will guide you into that information, or it guide you into different bits of information that is going to support you. So if, again, you are, apologies about that, if you are struggling to grasp a concept, and this is any of the topics, read the case study, read the information that's available to you, and it will support you in that answer. So the next thing that I'd like you to look at is those costs. So we're calculating our different types of costs. So this could be anything to do with our variable costs and our fixed costs. So our variable costs are those that change with the level of output. And that yellow isn't very good, so I'm just going to change the color there on the pen. So my costs, okay, my variable costs change with the level of output. And what I mean by output is how many we sell or how many we produce, depending what we are looking at. So my variable cost, and I'll give you a working example in a minute, okay, but might be 90p. So you're looking at, if you sell 10 items, it's 10 times 90p. Okay, it will give you your variable costs. My fixed costs, and hopefully you remember this because it's a key one, they stay the same. They're fixed. Okay, so these stay the same. So if you sell 0 items, or if you sell 10,000 items, you always have to pay those fixed costs. So a typical example would be rent. So rent, if you sell nothing and you've got a building, you are always going to have to pay that bill. Yeah, it stays the same. So then we get our total cost by adding our fixed costs and our variable costs together. Okay, I hope that is relatively self-explanatory. So the next slide is a little bit of a working example again. So I'm just going to go through this one, and then I'm going to give you a couple of minutes to have a look and work out and calculate some bits for yourself. So calculate the profit and loss for the following business for 2021. So a local pet supplier has on average 400 customers per week. The shop is open for 48 weeks in a year. The average selling price is £15. Fixed costs are £100,000 and its variable costs are £150,000. So he could ask you to calculate your revenue for that week. So again, we look at our selling price, and I would always recommend writing out the formula because you can get a mark for that sometimes in certain questions. So selling price times number of items sold. We then put our information in. So 15 times 400. So now we are calculating our revenue. Then I would go for, I'm just going to put an R there for revenue. I'm going to calculate our variable costs. So depending on how many we're selling our week, so again, write down your formula. So for our variable cost, it would be variable cost per unit times by number of items sold. So then we can put the information in. So we have a variable cost. Let's say our variable cost for that first example is, so what's the selling price there? Let's say it's £2. Okay, and we're timesing that by 400. So therefore, our variable cost is £800 for the week. Now we know our fixed costs. Oh, we've got our variable cost, sorry, of 150,000 there. Okay, so if you have to calculate it, it might look something like that, but in this case, we've got our total ones there. So from this, we can then start to break down that information a little bit more. Let's just get rid of that for a second. Okay, we can add our fixed costs and our variable costs together because we've already established that that's how we calculate our total costs. Just get my pen back on. So we have 100,000 and 150,000. So that gives us £250,000 in terms of our total costs. So now we can work out our revenue. This isn't a very good example because of the figures we've used, but 6,000 take away 250,000. So our total revenue minus our total costs would provide us with our profit and loss. So then if we looked at it for the second year, we may see something different. So again, our price, the average selling price has fallen this time for £12 for whatever reason, but we've remained the same at selling the same amount of goods. So can you work out your profit and loss for 2022 based on that information? Again, pause the slides now, okay, and then we can move on through the rest of the presentation. Just going to check, see if there's any questions. Okay. So again, a second question. So what was the total revenue earned from the sale of 200 units of a product at a price of £10 each? What were the total costs, including 200 units of the product, were made, including raw materials, labour head and over expenses, if the costs were £2.50 for a variable cost and £90,000 for a fixed cost? What is your profit and loss? So again, if you would like to have a go at this yourself, please pause the video. Okay, if you would like a little bit more of an explanation, then please just stay around. So to work again, we're working out our total revenue. So now I'm just going to abbreviate it to abbreviate some of the terminology. Okay, so I'm going to work total revenue equals selling price times by number of items sold. So now we go for our selling price is £10 per item, and we've produced or we've sold 200 items. So therefore, we've got our total revenue, which is nice and easy. Don't forget to put your pound signs in. Then you've got to work out your variable costs. So our variable cost in this one, so we've got variable cost per unit times by number of items sold. So again, now we can go for £2.50 times by 200 equals our £500. So now we can add those two together, gives us our total costs of 2,500. Oh no, it doesn't. Sorry, I've got a total revenue. I've got my variable cost there. Okay, and then I can add on my fixed cost of £90,000. So it's £90,500. And again, very, very expensive there. Okay, in terms of our profit and loss. So it could be that we've bought some machinery, or we're expanding, we're growing our business. Okay, so again, you're trying to put into context what is happening within that organization. So hopefully in terms of revenue, the key things to remember is a selling price times number of items sold. Your variable cost is your variable cost per unit times number of items sold, and your fixed costs always remain the same. Now moving on to break even, where we use lots of that information already. Okay, you will get a table. So I'm sure that most of your teachers will have expected you to draw out this table at some stage and draw a graph. Now that's not needed in the actual paper. It's just to try and get you an idea, an understanding of what's going on. So in this example, I have various different A, B, C, and D for my exam questions. So can we calculate the break-even point in the cafe? We'll work that out in a second. So first of all, we look at my table. So again, we gain an understanding. The fixed costs, we can highlight there, okay, and understand that they always remain the same. We've got our variable costs. So in this case, it's 90p. So our variable cost, we know that's variable cost per unit. Times by number of items sold. So again, it's 90p times by how many we've sold at that stage, which is 2,000. So 2,000 times by 90 is 1,800. So we can then put into our element here 1,800. Now you may be, and I'll tell you a quicker way in a moment for some people, especially those that are already competent at maths. So your total cost we know is our variable cost plus our fixed costs. So in the case of C, we've got 5,000 for our fixed cost, and we've got £1,350 from our variable cost. So that gives a total of £6,350. So then for D, for our total revenue, again, and we should again know this by now, but we've got our selling price times by number of items sold. So our selling price is £5 in this case. And again, we've sold 500 at this stage. So 500 times 5 gives us our 2,500. So we've managed to fill out a table based on our knowledge of profit and loss, so revenue and costs. So from here, we can start to then build some pictures. So these two columns then become very, very important for us. We've got our total costs and we've got our total revenue. So can we, with our total costs, can we work out where approximately we are breaking even? And hopefully where our revenue exceeds our total costs is where we're breaking even. So it's somewhere in between 1,000 and 1,500. So as you can see, when we've sold 1,500 or produced 1,500 items, we're making a profit. But at 1,000 items, our costs are higher than our revenue and we are still making a loss. So let's look at a formula for break even. Okay, I'm just going to try and find some space on here. In fact, I'm going to get rid of some of that for us. So I'm going to work out our break even. So we can use something what we call contribution. So contribution is simply our variable costs per unit times by, sorry, let me just go read that again. So our contribution is our selling price minus our variable costs. Now to work out our break even, we simply divide our fixed costs against our contribution. So in this case, we've got £5,000 divided by 5 minus 90p. So we can work out that to start with. So it's £4.10. So we know that's my contribution. So 5,000 divided by £4.10 gives us a sum of 1,219.5122. Now, when we're looking at break even, we're looking for number of items that we need to sell in order to break even, or number of items we need to produce in order to break even. So we have to round up. So therefore it becomes 1,220 and put items. So if it tells you about coffees, okay, if it tells you about customers, put customers. Do not leave that blank and avoid putting a pound sign on the break even. So just to recall, it's fixed cost divided by our contribution, which is our selling price minus our variable costs. Now, just to give you a little bit more practice, I'd like you to pause your screen again. And you've got 5 quick fire answers just surrounding the topic of break even. Now, the answers for these 5 questions. So to check your knowledge, you can obviously hopefully unpause yourself by now. The first one is B. So we determine the sales volume needed to cover all costs. The second one, what does break even represent? It's the point where a business covers all of its costs. So again, it's B. Question number 3, what is the formula? So break even divided by is total fixed cost divided by selling price minus variable costs. C is not a variable cost, would be rent. D would be all of the above. So what is it used for? It's used to make decisions. It's used to see what is the most profitable product. It's to look at what pricing strategies we might use. So depending on that break-even point, we can increase our selling price or we can decrease our selling price. And I'll tell you what happens in a minute about those different changes. And it can be simply to whether or make decisions. So can we decide whether to expand or downsize? So then if we go on a little bit further, if we try and analyze this break-even analysis and what are we using it for, it might be that it allows us to look at what will happen in the long run. And we're producing something called what if scenarios. So if the price or cost of something change, it's going to be impacted. And this is a nice little table just to represent that. So a rising cost would mean the break-even point increases. A falling cost means that break-even point decreases. A rise in prices means the break-even decreases. And a fall in prices would make that break-even price increase. So moving on to the next sort of concept, okay, and I know we're flying through these, we've got profit and loss account. Now we should know what profit is now. It's the difference between the sales revenue and the total cost. We've looked at that already. Now we start to then use some different formulas, okay, to analyze what's going on within our business. So we're looking at some numbers, something that's happened. So we look at our gross profit, and our gross profit is the profit made before expenses have been paid. We also look at our gross profit margin. So we can use that to analyze our business. We can analyze the performance. We can analyze how well they are doing. So the gross profit is expressed as a percentage. So gross profit divided by sales times by 100. And you can see that formula on your screens there. The net profit comes after all expenses have taken place. So it's the final profit made by a business after all of those costs have been paid. So that then becomes our gross profit minus our expenses. And I'll work through that in a minute just to show you an slightly easier way on how to analyze that. So our net profit margin, again, another tool for analyzing performance, is our net profit divided by sales or sales revenue times by 100. And it's just something that you've got to remember. Now, if we look at it in terms of an exam question, we have it in a table and it all fits into each other. So we start to begin to recognize our gross profit might be something that we are asked to calculate. So what do we do with that? So we have our sales revenue minus our cost of sales equals our gross profit. So it's in order. So when you get to the profit and loss account, if you get a question that comes up in this, it breaks it down and it breaks it down into smaller chunks. Again, if we're looking at our net profit, it helps out again because all it is our gross profit minus our expenses. So it's in a order that we can start to process that information and hopefully understand what is going on a little bit more or make that sum a little bit easier. So our gross profit, sales revenue minus cost, 70,000 minus 40,000 gives us £30,000. So what happens with that net profit? And it's something that's often overlooked. So some of it is given to the tax. Some of it will be distributed by its owners, whether it's a group of shareholders, whether in a PLC or private limited company, or whether it's a sole trader or partnership. Some of it will simply be ploughed back into the business. And others might be kept in reserve just in case. If there's any unforeseen circumstance, or if they're saving for investing in a new piece of machinery. So again, a little example. Here we've got our sales revenue minus our cost of sales equals our gross profit. So pause your screen again and you can have a go at these questions. So we have £5,445,000 take away 202,500. That gives us a gross profit of £342,000. Now we can then take off our other expenses and see how we're going down the table to give us a net profit in 2020 of £57,500. So I'd suggest the business is performing well. Now let's have a look at the second year. So now we've got £590,000. So our sales revenue has increased. Our cost of sales has also increased. So again, we're looking at 590 minus 212 gives us £378,000. Then we take off our other expenses. And we have a negative £7,000. And we can represent that in a bracket. So we don't need to put a minus, we can just represent in a bracket because that is how accounting terms are sort of calculated. So now you can say, right, well, actually, in 2020, you can see the business is performing well. Why is it performing well? Because we have sales revenue and we're in control of our costs. What's happened in 2021? Our sales revenue has increased. Our cost of sales has increased. So therefore, our gross profit has. So our actual gross profit based on our sales figures, we've improved. Now, actually, our expenses are the ones where we're concerned here, and we can highlight that now. So again, if you're getting a 12-mark question or a 10-mark question in your exam, you're starting to think, right, well, this is the area where something happened. Now, what might have happened in this business is they could have invested in a large piece of machinery. They could have increased the size. They could have expanded. So actually, whereas the business performance looks bleak because our total profit or our net profit has decreased in 2021, it may be because we've invested to expand. So these are the analysis points. These are the higher level skills that I would like you to think about. So talk about the point, explain it, give me an impact on that business. So looking at an exam question. So bespoke company makes sells a range of made to order wooden furniture, and it's through its website, allows customers to furniture from a range of options. They use CAD and CAM, so we know they can use some kind of technology within there, and you get your profit and loss account. Now this one's just giving 1 year, so we're just simply calculating our gross profit and our net profit margin. So again, you're going down it, 1,600 minus £840 gives us our gross profit. I'm going to leave that for you to calculate. Our gross profit margin is our net profit divided by our sales revenue times by 100. So again, we get given a percentage where we can start to analyze the business performance. And if you look on the right hand side, you've got 3 marks available for this question. 1 for your formula, gross profit, sales revenue minus cost of sales. Formula for calculating net profit margin, net profit divided by sales revenue times by 100. And then you're using that formula to calculate that sum. So not a difficult question, and again, easily accessible marks with a little bit of revision. So a second example, so XYZ Limited. So we've got two years figures here. It's just going horizontally as opposed to vertically. So you can see our sales revenue, we've got our cost of sales, and we've got other costs. Calculate your gross profit. Calculate your net profit. You can then go on to calculate your gross profit margin and net profit margin. And those of you that want to use this, come back to it, because I don't want to keep you for too long, because I know you'll lose focus. Okay, then analyze it. Analyze the business performance. Use that as an 8-mark question, and it will help you to really understand that answer. Now, the last little bit is cash flow. So again, this is a topic that has been removed for the last few years, but it's back in on your specifications. So your cash flow forecast, and again, you're using this map to sort of support your learning. It sets out the business's expected inflow and outflow. Now you've got that keyword expected. So it's a prediction, it's a forecast. So this isn't something that is set in stone, it's just what somebody is predicting. So you can start to analyze the use of a cash flow forecast. An advantage is it gives you an indication of closing balance, profit, net cash flow. However, it's based on predictions and could have been produced by somebody who's unskilled. What does this mean for the business? Impact. Again, going back to that TED, tell me something that's happened, explain it, tell me about the impact of it. And you've got the ways to improve it on that right hand side. So that impact for this could be, how are you improving your cash flow? So you're buying cheaper materials. What does that mean? This will reduce production costs. What will that do? It generates more custom. So you've got these chains on this right hand side in this column here, which I can't stress enough, where you've got your talk about the point, you can explain it, and you can tell me about the impact. You're developing it. So please, again, use that information, use these knowledge organizers to support your learning. So typical exam question again. So we have 3 options, 3 question marks. We've got our total payments. We simply add up our payments to get that total. So those three elements added together, and I haven't got unfortunately I haven't got the answer. Do I have the answer? No, I haven't got the answer worked out, calculated already, but you can add those up and work out your total payments from that information. And it will give you £8,480. Your net cash flow. So again, we should be aware that our net cash flow is our total revenue minus our total payments. And if you're unsure, you get to this question, you see a table, look at another month that's complete. So October, for instance. So how have I got that net cash flow? And again, you can look at these sums and you can see, hopefully, all right, there's a -50. That's it. It's my revenue minus my total payments. And it's these triggers that are going to help you and support you just going forward. So then your closing balance is simply your net cash flow plus your opening balance. So you're using the information in a logical format again. Okay, net cash flow, take away opening balance. And that's your simple cash flow forecast. You're probably getting yourself 4, 5, 6 marks for that. Outline 2 ways in which it would be useful. Tell me about different stakeholders. Recommend 2 ways of which a business could improve its cash flow, increase its selling price, increase marketing, reduce its payments. So you've got different things again that you can talk about that can help you to answer this question. Now, just as we come to sort of a close on this, we can just have a look at a couple more questions in a bit more detail. So state the monthly break-even point, number of customers for Nori's Nail Bar. Now, in this example from WJC, they say the number of customers. I personally feel that's a little bit cheating. Okay, but we've got some information there. We've got that our currently charges £15 selling price. We've got our fixed costs. And hopefully you should be able to pick up that that's £1,000. Then we need to try and work out our variable costs. Now this is quite a tricky one because we're looking about what our total costs and we're taking it away from our sort of fixed costs. So if we sell 100 items, I know my total cost is £2,000. So if we sell 100 items, fixed costs equals £1,000. Okay, £2,000 wasn't it? Yep. So £2,000. Now my fixed cost is 1,000, so I'm just working back. So I take away that off my total cost, which gives me £1,000. So we've got the difference there, and we can calculate then our variable cost. So we've got 100 items, so we're dividing it by 100, which will give us a variable cost of £10 per item. Now that's one way of doing it. The second would be to draw your total revenue line on. Now we can just work out our total revenue. I know I showed you in a big table. I'm sure you've been told that in your classes, but we can just work it out at selling 0, and we can work it out at selling 400. So we know our revenue is 15, or our selling price times number of items sold. So we're starting at 0, and we know 15 times 400 would give us £6,000 in our revenue. Now, unfortunately, I haven't got a rule on this thing, but we can draw our total cost line, and it would give you your break-even point where your lines cross. So you're using that information to try and calculate your break-even point. So you don't even need to go through the calculation to work out your variable cost. Okay, you can just calculate those 2 points and make sure you've got a ruler to answer that question. Now, again, I'd just like you to go through 5 quick fire answers, quick fire questions, so 4 questions on this one actually. And you're looking at different types of fixed costs and calculating your break even through contribution based on the information that's provided to you. So just again, we've got our selling price, we've got our fixed costs, and we've got our variable costs. Pick out that information from the context. So if you're struggling again, you can have a guess at it or an estimated guess at the worst case scenario. So 300 divided by our selling price minus our variable costs. So 300 divided by 10 would give us an outcome of 30. What is it? 30 products per month. Okay. So again, you're writing that product per month element. Now, just to finish off, again, a quick 5 multiple choice questions, all to do with profit and loss and cash flow forecasting. So if you'd like to pause your screen whilst I run through the answers, that'd be much appreciated. Okay, so our purpose of a profit and loss account would be to show businesses' expenses and income over a period of time. What is the difference between revenue and profit? It'll be the total income of a business, whilst profit is the income after deducting all expenses. So you're trying to determine between what revenue and profit is. What is the purpose of a cash flow forecast? To predict or forecast, in this case we're using the term predict, the amount of cash a business will receive and spend in the future. What does a negative cash flow indicate in a business? A business will have to take out a loan to cover its expenses. So it comes back to tying in that source of finance topic we talked about at the start. And finally, we've got that end section. Why is it important for a business to regularly review its profit and loss statement? We have D, all of the above. So again, it's just some key questions to help you in that sort of revision.